Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, I'm talking with Jonathan Shelon, Chief Operating Officer at KraneShares. We've seen very strong demand for covered call ETFs over the past year, and a lot of ETF companies have taken advantage of that by launching covered call ETFs tied to all sorts of different assets. That includes your company, KraneShares, which recently launched a China Internet covered call ETF with the ticker symbol KLIP. Can you tell us about that fund?
Sure, absolutely. So we've been spending a lot of time researching the covered call space, and that research actually began sometime in 2022. And we became very excited about our ability to deliver something really unique in the covered call category. And there are a couple of reasons for that, but what we concluded was that after spending, between 6 months and a year studying the space and what we could deliver, we concluded that we can create something that has very attractive distributed yield potential compared to what's out there in the marketplace. And that's because covered call strategies depend on volatility, what's sometimes referred to as implied volatility in the options market. And the strategies that we specialize in, namely China-focused strategies, and in particular, China Internet, has much higher volatility than things like the S&P 500 or the NASDAQ. So when we thought about what we could do here, we got very excited. And so what we've done with KLIP, which is KLIP, we launched that ETF in February of 2023, and we've taken one of our flagship strategies at KraneShares called KWEB, KWEB, and KWEB invests in 32 China Internet and e-commerce stocks. And the KWEB basket has volatility of around 40%. And that's higher than the S&P or the NASDAQ. I think most of your listeners will be familiar with the fact that, in normal times, the S&P has volatility that's 10 to 15%, and the NASDAQ somewhere in the 20 to 25% range. So 40% is a real premium volatility. But what we do is we buy KWEB and we sell at the money calls on KWEB. And what this has done is produced an option premium of somewhere between 4 and 5% per month. And so we collect that option premium and then we pay it out at the end of that month. So that's kind of the essence of the strategy, and I would love to spend more time talking about some of the intricacies, but wanted to pause there.
Yeah, those are very compelling yields that you're getting from this ETF. Jonathan, one way I think about covered call ETFs is that you're kind of giving up some upside in exchange for guaranteed income. But with China stocks so depressed, what's the thesis for giving up so much of your upside? Is it fair to say that this type of ETF is designed for people who think China stocks are going to be range bound?
It's interesting. A year ago, I would have said yes. But now that we've seen investors purchase KLIP and understand how it's being used, there are a few different answers to that question. So in one case, investors are saying, what I really want is this stability. I wouldn't say guaranteed in our case, but a more stable income profile that I would get, with other strategies, and certainly a higher level of income. It's tough to get distributed income of 4 to 5% a month, right? That's fairly high in the marketplace. And what's important to remember is that when you buy a covered call ETF, whether it's KLIP or some other, you're basically substituting uncertain upside for stable income, but you are still taking on the downside, right? So there is still a downside component. So what we found is that a lot of our investors that buy KLIP either buy it because it produces this higher distributed income, or it's a way of reducing volatility of their KWEB exposure. In other words, KLIP has proven to have volatility that's about 40% lower than KWEB itself, because this income creates a dampening effect and a cushion in turbulent times. So some of our investors that are familiar with KWEB are saying, okay, I can blend KWEB and KLIP to create a customized growth and income strategy. I may not need 4% distributed income. I may only need 2%. So in that case, I'll buy 50% KLIP, 50% KWEB, thereby maintaining my upside potential. So we've seen a lot of customization as a usage. And of course, some of our advisor clients are building income-oriented portfolios that may include high yield, it may include dividend-paying stocks, it may include other forms of traditional fixed income. So in that instance, they're just trying to diversify the relationship between the different pieces of their income portfolio. And much like KWEB has low correlation to a lot of other strategies because they are effectively stocks listed in Hong Kong and US ADRs, people are able to get better overall portfolio risk and return characteristics by putting CLIP into their portfolio.
Really interesting. Do you think that investors who buy CLIP have to necessarily take a directional bet on China? Do they have to have a strong opinion on where Chinese stocks are going? It seems to me, as long as Chinese stocks don't, fall precipitously from here, the ETF should do at least decently, right?
I think that's right, and that's kind of what we're seeing here. This has been a very interesting year for Chinese stocks in general. January was a tough year. There were these, bull bear contracts in Hong Kong that ran into some trouble in January, and that brought down many Chinese stocks. So performance was not great in January. But if you look from February on, you'll see that KWEB is up 22% since Feb 1 through the end of April, outperforming NASDAQ by 20%. People haven't realized this yet, but times that are good for KWEB will also be times that are good for CLIP, because while you won't get the upside that KWEB offers, you will get this income with less drawdown risk. So what we've seen happening is that we've had attractive returns in KWEB and CLIP over these last 3 months. And a practical decision is this. If you think that KWEB is going to be in a very strong upward rally and you're a return-only investor, then you should just buy 100% in KWEB. However, if you're a risk-adjusted return investor, having the ability to dampen volatility from what is traditionally a fairly high volatility asset category is very attractive. So in a risk-adjusted sense, having some combination in CLIP and KWEB could make sense a lot of the time.
That makes a lot of sense. I want to switch gears a little bit, Jonathan, and talk about another group of funds that you have, and that is your buffer ETFs. Why did KraneShares decide to get into the buffer ETF space now, and how do your funds differentiate themselves from the competing ETFs that are out there?
Sure, absolutely. We after launching CLIP, we realized that we built out very good expertise internally in using options to build customized patterns of return. And so it was only natural that we would start looking at defined outcome strategies. And truth be told, the last 2 years in the China space have been challenging. China's been in a fairly severe drawdown up until pretty recently. And that's partly because China had a zero COVID policy that was really quite strict and hasn't opened up its economy until much later than the US had. So in a way, China's on a 2-year delay vis-a-vis what we've seen here in the US with their economic experience. And I would also mention that China didn't go with a stimulus bazooka like we did here in the US. In the US, we were literally handing money out, right? We spent over 30% of GDP on stimulus. China spent 5 or 6% on stimulus during COVID. And a large part of that is because the Chinese consumers have been massively saving. There's $3 trillion of cash on the sidelines. So China's in a very different economic place than the US and has been challenged with market performance as a result. That said, a lot of our clients have been coming to us and saying, I love the ideas behind China. I love thematic investing in China. I understand the consumer story and where it's going and the technological advantages and the urbanization. I understand these megatrends, but I don't want to lose the kind of money that I lost or could have lost in the last 2 years. So for me to get involved in China now, even though I know valuations are compelling and fundamentals are compelling and everybody's underweight, I need some level of protection. And it doesn't have to be pure protection, but I need some level of protection. So we started doing research on defined outcome, and we realized that we could create, very unique strategies with very decent economics with periods of time as short as 2 years. So in February of this year, we launched KPRO and KBUF. KPRO is a strategy that from inception would provide full protection, 100% downside protection from that starting NAV, as long as you held the ETF until January of 2026. So roughly a 2-year period. And then KBUF would provide 10% downside, so 90% protection, also over a 2-year period. And what makes these unique is with KPRO, the upside cap, the maximum return that you could earn in KPRO was about 22% over this defined outcome period. And with KBUF, because you're taking a little bit of downside risk, you can earn as much as 41% over that full outcome period. And those are what makes this unique. And again, this goes to my earlier comments about the role of volatility, is that these are higher numbers than you could achieve if you were to create similar structures for US-based ETFs. So if you were to do this with the S&P or the NASDAQ, you wouldn't be able to earn 22% or 41% over a 2-year period. Those are very unique economic outcomes. And in my opinion, I think that given where valuations are for China versus the US, it's much more likely that you could hit those caps in the China markets than US and other global markets where stock markets are at record highs, whereas China is at multi-year lows. So, we thought it was a very compelling opportunity for very risk-averse investors to get a toehold back into the China market. It allows you to baby step in, but still get the downside protection you're looking for with reasonable upside opportunity. Again, you cannot do as well in these types of defined outcome strategies as you can in KWEB itself. In other words, if KWEB rallied 100% over the next 2 years, you can't earn that when you have principal protection or a buffer, but you can earn something quite attractive, double-digit annualized returns, whether they be 10% or 20% a year. Those are pretty attractive returns if KWEB starts to move quickly.
Fantastic. Well, Jonathan, you got some really unique, interesting products. It's going to be exciting to see how they perform and what the demand is for them as we move ahead. It's been an absolute pleasure having you on the show. Thanks so much for your time.
Thank you. Thanks for having me.